Good afternoon. It's a great pleasure to be here this afternoon. We're meeting here, and if we're going to talk about finance, we have to keep in mind that we're meeting in the shadow of one of the great economic events of our lives and one of the defining events of the first half of the 21st century, which is the Great Recession, one of the greatest financial crises in the history of the world, as it happens. Now, it is a cliche, but nonetheless true for that a crisis creates opportunity. And I have thought for a long time that Utah and its businesses are particularly well placed to take advantage of some of the opportunities that are created by this crisis. But to take advantage of a crisis requires a clear view. It requires a calm understanding of where we are and what's driving our situation. It requires a clear sense of where you can go in order to take advantage of where the world is going to go. So what I want to do in the short time that we have this afternoon is to talk a little bit about what those drivers are, where we are, how we got there, what that implies for where we're going, and how Utah businesses can take advantage, some of the mechanisms for them to take advantage of the international opportunities that have been created. So let me begin first with a little survey. How many people here think that the worst is behind us? Okay. How many people think that corporate profits are going to be higher in 2014 than they were last year? A few more hands, quite a few more hands. How many people think that unemployment is going to be lower next year than it is this year? Moderate number of hands. How many people think that inflation is going to be higher next year than this year? That's interesting. And it's interesting the different reactions you get when you ask this question in different parts of the country and different parts of the world. And then, where is growth going to come from in the world over the course of the next decade? What's going to be the principal engine of the world's economic growth? Is it going to be the United States? I got one hand. Europe? No takers on Europe. China? Fair number. India? Decent number. Brazil? Latin America, take that as a proxy for Latin America generally. All right. Well, now that we know what each other thinks, let's talk a little bit about what some of the drivers are that are behind the answers to those questions. For the last quarter of a century, up until the financial crisis, we've been living through what the economists have called the Great Moderation. Essentially, you had very stable monetary policy, you had reasonably flexible regulatory policy that resulted in an environment that was predictable and quite favorable for economic growth. And as a consequence, there was a sustained period when, from a financial point of view, nothing bad really happened. Certainly not in the developed world. There were emerging market crises. There was even a market crash in the United States during that time. But there was immediate recovery. There was no sustained damage to the financial sector from anything that happened during that period of the Great Moderation. And as a consequence, those of us who worked in the financial sector got complacent. And we began to extend credit in ways and in amounts and to borrowers that never would have been countenanced at the beginning of that process 30 years ago. And the result was an explosion of leverage. In the beginning of the 1980s, the total amount of leverage in the US economy, that if you added it all up, households and the government and corporations and the financial sector and all the debt in the economy, and compared it to our GDP at the time, it was 120% of our GDP. At the outset of the financial crisis, it was 350% of our GDP. And in the financial sector, that was even more dramatic. Financial sector leverage in 1980 was 20% of the US GDP at that time. At the outset of the financial crisis, it was 120% of our GDP, just in the financial sector, a six-fold increase over the course of that period. And then, in 2007, some rashly extended credit, household loan credit, to borrowers who could not afford it, began to go toes up. And people began to look at the amount of capital that was in the financial sector. How leveraged were we? And they realized that if there was going to be a large demand on that capital, as it appeared there might be from the subprime mortgage crisis, there was not enough capital. We were wildly over-leveraged in a world that had become dangerous, that was no longer as safe as we had complacently grown to believe. And as a result, the private sector pulled back and stopped providing that credit precipitously. That was the definition of the crisis. And again, to understand where we are, the next step is very important. The government decided to step in and substitute its credit for the private sector. And very consciously, this was a two-step process, and then in an orderly fashion, when the panic had passed, to shrink that balloon down to a sustainable level. So all of that alphabet soup of programs and all of the drama from 5 or 6 years ago that we all remember about what the Treasury was doing, what the Federal Reserve was doing, all of those were simply different mechanisms to do one conceptual thing, which was to substitute the government's credit for the private sector's credit. The first part of that's now done. We've had TARP and stimulus and a significant increase in the debt-to-GDP ratio in the United States, a doubling in just a few years. Even more importantly, to my mind, whoops, that's going backwards. Even more importantly, to my mind, the Fed's balance sheet has quintupled. The Fed had a balance sheet of $800 billion at the outset of the crisis, and it's now over $4 trillion. And again, all the talk in the newspapers about tapering simply means that the Federal Reserve is slowing and stopping the increase of that balance sheet. It's still 5 times what it was at the outset of the crisis. So, we mentioned that at the outset of the crisis, the aggregate amount of leverage in the United States was 350% of our GDP. To know where we're going forward, it's important to understand how, over the course of the last 6 years, where we are on that continuum, on that process of shrinking that number. So we've had 6 years of recapitalization, we've had 6 years of recovery, we've had 6 years of, a few years of positive, if modest, growth in the United States. So does anyone want to, who knows how far we have shrunk that number, from 350% to what? Who wants to take a guess? Anyone want to hazard a guess? Lou? Does anyone want to counter that? Well, Lou is wrong. Because it's not the same as it was at the outset of the crisis. It's actually a little higher. It's slightly over 350%, because the government has stepped in to substitute its balance sheet for the private sector. And so markets, particularly in the United States, are acting as if we are on the other side of this process, as if we are at the tail end of the consequences of the financial crisis, when in fact they have not begun. That shrinking of the balloon, which has to happen, the shrinking of the Fed's balance sheet, from over $4 trillion, the recovery of the Treasury's balance sheet from the heavy deficits of today, will take place for a long period of time, and that creates a significant headwind to the real economy. If the financial sector is trying to shrink its assets, it can't grow its assets by extending new loans. And this is true throughout the developed world. The consequence of these headwinds is that growth in the United States and in the developed world generally remains significantly below our potential. Now, this chart shows economic growth, our GDP, compared to our potential GDP since 1980. The vertical gray lines are recessions. And as you can see, there have been significant dips where our actual growth is below our potential growth after a recession, and it shoots right back up. Because the level of economic growth after a recession is generally much higher than it was before. The exception was after the great financial crisis. We are still below our potential output. We will remain below our potential output for up to a decade longer. To put that in perspective, if to alleviate your despair at the state of the world, you threw yourself into the arms of a loved one and conceived a child on the night of the Lehman bankruptcy, that child will have graduated from high school before we are on the other side of this. Europe is in actually worse shape than we are. Don't believe the narrative that says that we exported our lax regulation, creating a crisis that went around the world and has caused problems in Europe. Europe was far more highly leveraged than the United States. And as a consequence, their financial sector is experiencing even greater problems than the United States. So if the developed world is facing these very strong headwinds as a consequence of the events of the last 5 years, what does that mean for growth? Where is growth going to come from the world? Well, this chart is from the IMF, and it shows current output compared to what they would have predicted at the outset of the financial crisis. And as you can see, the advanced economies are 12% lower than they would have been expected to be. The emerging markets and developed economies are actually almost 3% higher, about 2.5% higher than where they would have expected to be. Keep in mind, this is not growth. This is the excess growth beyond what one would have predicted from the very high levels of growth that many of those economies were experiencing before the crisis. Emerging and developing Europe, the states of the former Soviet Union, significant deficits, but developing Asia, Latin America and the Caribbean, sub-Saharan Africa, these are all outperforming significantly where they would have been expected to be at the outset of the financial crisis. And a significant reason for that are the factors that we've just been discussing. And significantly, the nature of that growth is being driven by the consumer economies of the middle class. Nearly 2 billion people are emerging into the middle class in Asia and South Asia. And the consumer consumption demands of that middle class are increasingly driving economic growth in those regions and creating opportunities for internationally active businesses. So, in the last 30 seconds, I want to give you a case study of something that we did when I was at the Carlyle Group that takes into account all of these factors. Montclair was a company that specialized in high-end ski apparel. Luxury outerwear, I think, was the technical name of the category. We bought 48% of them in 2008, right at the outset of the financial crisis. And we did that with the expectation of executing on exactly the factors that we've been talking about now. The emerging middle class, in Asia in particular, was getting into sports like skiing. And even if they didn't ski, they loved to look as if they skied. And particularly with high-end ski wear. And so, in addition to our capital, we brought them expertise. We brought them the ability to expand. They increased their retail outlets from 6 to 56 over the course of 2 years, from 2008 to 2010. Those retail outlets were in places like Beijing and Shanghai and Hangzhou and Shenyang and Nanjing. We got them a head of retail operations from Gucci. We helped them recruit a new head of US operations and Chinese operations. We helped them coordinate their distribution in Japan to convert all of the distribution agreements into joint venture agreements that they fully controlled. And the consequence of that marriage of capital with expertise was that in 2 years, Moncler had increased its revenues by 42% and its EBITDA by over 90% in 2 years by executing on this strategy of international expansion, which was driven by the factors that we've just been talking about. That the developed world would be restricted in its ability to grow, and particularly for high-end goods, whereas the emerging world was the future market, that was the most robust market. So, in conclusion, what I want to say is we are in a world of opportunity, but it is an opportunity that is unbalanced. The developed world will face strong and durable headwinds for a significant length of time. The emerging world has both robust growth and growth that is being driven increasingly by consumer consumption. It's possible for businesses all around the world to take advantage of that, particularly if you're focused on consumer consumption. And one of the best ways to do that is by partnering with someone who can bring both capital and expertise, and that partnership doesn't mean having to give up control of your company, but that it can, in fact, create significant new opportunities while you retain control of your company. What you make of those resources and those opportunities is entirely up to you. Thanks very much.